All righty. So thank you everybody for joining us today. We will just get started now as I see the numbers increasing here. So thank you everyone for joining our webinar, Digital Assets Portfolios Beyond Baskets and Indices. My name is Joyce Chu. I'm InvestTech expert at InvestSuite, and today I am joined by our speakers. First, we have Matthew Hardy, Lead Business Development Manager for the Portfolio Optimizer Solution at InvestSuite. Matthew was previously leading product and subsequently business development with Awesome Finance, a crypto wealth manager who launched the first crypto robo-advisor. And we also have Martin Wins. He is the product manager for the Portfolio Optimizer. He's joined InvestSuite as a quantitative analyst and having previously held roles in quantitative portfolio management at the likes of KBC Asset Management. So before we get into the webinar, you will find a Q&A box at the bottom of your Zoom screen. And there you can feel free over the course of the webinar to pop any questions. And we will try to get to them at the end of the webinar. And of course, if we don't have time, we will ensure to address them personally. So please feel free to drop any questions in the Q&A box, and we will ensure to get towards you. So first, just on the next slide, before we get started, a brief about InvestSuite. We are a global business-to-business embedded wealth invest-tech provider. We're based in Belgium, and we have grown to offices globally with our clients spanning across 3 continents and growing. So as our name states, InvestSuite stands for a suite of invest-tech solutions. So a brief intro across the suite, starting on the far left. We have our B2B2C investment platforms, and we offer this across robo-advice for personalized digital wealth management and self-execution or self-directed investing for investing in your favorite companies and stocks. And all of these, or both of these, are white label solutions. Then in the middle on the right, we have our software as a service solutions. The center is our portfolio construction tool available in conjunction with the robo-advisor or as a standalone solution. This is Portfolio Optimizer, which we'll be talking a little bit more about today. And on the far right, we have our solutions that look to enrich and add value to the investing journey. So the Storyteller is a next generation way of portfolio performance reporting, and the Insight APIs are a full suite of modular APIs that can be used within existing platforms and customer journeys. So today we focus on one application for one of our products, and that's the Portfolio Optimizer and the iVaR risk measure applied to crypto specifically. So after a frenzy from mid-2020 to the end of 2021, crypto activity seems to have slowed down. But really, the undercurrents are forming with an increasing number of developers building, while regulators are clarifying the rules of the game globally. And demographic factors hint at more and more users and more value flowing towards crypto networks. But even to those thinking that this is an area worth looking into or exploring, building a portfolio of digital assets remains a complicated task because it's all still quite new, and it's so different from the traditional asset classes that we've been so used to. So on the next slide, we just have a brief agenda to come that includes first an explanation into why invest in crypto assets. Then we'll go into digital assets and weighting using some of our tools. And finally, the proof is in the pudding with backtests of how this works in practice. Now, diving into the webinar, let's first look at the rationales for considering an allocation to crypto as part of your portfolio and the various options for building that allocation. I'll pass it over to you, Matthew. Thank you.
Thank you, Joyce. So yes, as the relevance of crypto can at times be a bit of a divisive topic, let us take a minute to consider why they might be an interesting asset class to contemplate. Beyond the price volatility, there are some elements that one might want to consider when contemplating this new asset class. So first, the hype is inherent to the new technology space. It might seem spectacular, but it's nothing to the trained eye. The Gartner hype cycle has theorized it pretty well long before crypto came to the fore. You probably remember the tech bubble. And then recently, a 1-month-old French AI company with 3 founders, no team and no product, raised 113 million at a 260 million valuation. So while price swings and hype is very visible in crypto, as it is much less gate-kept than the venturing industry or IPOs, and capital formation is much easier, it's really quite standard for tech. Second, prices might have pulled back from historical highs, but the rate of growth of leading and lagging indicators hints at the idea that digital assets might still have some wind in their sails. Just taking 2 for the total market capitalization over the past 3.5 years, the compounded annual growth rate is still about 67%. And then the number of developers in crypto over the same period has compounded at an annual growth rate of about 26%. Third, if you look at who generally finds that asset class interesting, it's Gen Z and Gen Y, and they are looking to, they're going to inherit the earth and all of the trillions of their parents' money in the greatest wealth transfer in history. Fourth, crypto networks are networks before they are anything else, and they seem to be growing in much of the same way that other networks did before them. Could say that crypto adoption is tech adoption. Mark Andreessen said that software is eating the world, and blockchains and crypto networks are new software primitives for transacting value and collaborating at scale without requiring participants to trust each other. Actually, Yuval Noah Harari's thesis is in part that we have become the dominant species thanks to our ability to coordinate at scale. And taken all together, it stands to reason that there might be something in crypto that enables us to take our next collaborative leap. If you want to attach an idea of value to it, Metcalfe's law states that the financial value or the impact of a telecommunication network is proportional to the square of the number of connected users to the system. And while crypto networks go beyond telecommunication, Metcalfe's law has also shown to offer good approximations for the value of Facebook and Tencent. And so it is reasonable to assume that as we go from 100 million to 1 billion users, the crypto networks become more valuable too. Lastly, aside from the US, the regulatory uncertainty is also being reduced. The European Union recently passed the Market in Crypto Assets regulation, which greatly clarifies the rule. London is actively consulting the industry as it draws up plans to become a crypto hub. Singapore, the MAS is upping its power. Abu Dhabi and Dubai are putting the final touches on regulation, and Japan has even made it a national strategy. The summary of this quick first section is that while the market is no longer in a mania phase, an increasing number of developers keep building with new regulation that clarifies the do's and don'ts, and the demographic factor point to more users and more people and value flowing towards crypto network. Now, if you did want to allocate to the space, how would you go about it? Well, if you rely on experience from building portfolios with traditional asset classes, you're likely thinking one of 3 things. Either let's take an index of the crypto market, or let's sell it as a fund, or let's look for the efficient frontier. And that is what can be seen in a lot of places on the market today. Indices and baskets are actually quite popular, but the results they achieve aren't very good. And that's because crypto is very much unlike traditional assets. It's best thought of as an alternative asset class for now and managed as such. So before we delve deeper into how crypto is usually offered today, let us start by reviewing the risk measures you might use for building a crypto portfolio, and Martin will take you through that.
Thank you, Mathieu. Let me share my screen. So now that we know why we want to invest in crypto, how should one do it? Typically, when managing a portfolio, it is important to manage and measure risk in your portfolio. But what does that mean for digital assets, managing and measuring risk? Well, typically, in the 1950s, Harry Markowitz came up with a modern portfolio theory. And since then, mean variance optimizations have been all around in the financial industry. However, with volatility, mean variance, it is assumed that volatility equals risk, that correlation is a static dependence, and that the risk-return characteristics describe your entire distribution. All assumptions that actually do not hold in real life, let alone for digital instruments. Let us therefore first list some useful properties of a risk measure that someone can think of. For example, not assuming any normal distribution of returns, only considering losses as risk, also called monotonicity, acknowledging that diversification in your portfolio decreases risk, also known as subadditivity, considering all aspects of the distribution, so also the tails, and last but not least, time to recovery from losses. How fast do you recover from losses? Now, circling back to volatility, we see that volatility only satisfies the diversification property. So what happened next in the financial industry was that value at risk VAR was developed by JP Morgan in 1993. Their CEO wanted to have a single number every day describing on how much money his trading desk could lose. And later this was even incorporated in Basel regulations for financial institutions. It basically comes down into the maximum loss in a normal scenario. However, it can be seen that it lacks a diversification property, and it does not take into account extreme cases. So as a result, in 2008, when scenarios were no longer normal, some banks went bankrupt. And given that normal scenarios do not exist in digital assets, this measure of risk will not serve our needs. Afterwards, people came up with conditional value at risk, or expected shortfall. It's a very known coherence risk measure. And how do we define it? Well, given a bad scenario, what is the average of bad scenarios? That's what conditional value at risk means. However, in portfolio construction, there are two main drawbacks. Mainly, first, you have to define a level of what is a bad scenario. If you take the average of the bad scenarios, you first have to define what a bad scenario is. And second, it doesn't include a time to recovery dimension. So it lacks the property of investing in assets that afterwards recover from their loss. Now, all of these observations are valid for both traditional instruments as well as for digital assets. And that is why we at InvestSuite came up with a general new measure of risk. It is InvestSuite Value at Risk, or shortly iVaR. And I will explain the concept in more detail, but it will be clear that our novel measure of risk satisfies all of the requirements above, and therefore is suited for both traditional assets, but also for digital assets. So how do we define iVaR? What is iVaR? So suppose that the blue line here on the screen is your historical portfolio value, then what we consider as risk is the sum of all light pink areas. So it combines three drawdown properties, namely how often do you lose money in your portfolio, what's the size of those losses in your portfolio, and what is the time to recovery from those losses. As can be seen, all of the desired properties from the previous slide are met. For example, we do not assume any return distribution here, and we don't even make any assumption about the dependency between instruments. And this makes iVaR particularly suited to construct portfolios with exotic instruments, being it financial options or digital assets. And also it has a human-centric aspect. So because although most of us are professional investors, when we look at our own portfolio at night, we don't really care about volatility. We look at, did we lose money in our portfolio? And if we lost money, how fast will we recover from it? And therefore, we claim that InvestSuite Value at Risk, so iVaR, is also a human-centric measure of risk. And it becomes clear that when you minimize for iVaR in your portfolio, you actually try to create the smoothest possible ride, given the range of instruments, given the range of assets that you consider to be picked up. So once more, zooming in on why this is particularly interesting for digital assets. So it's not assuming any return distribution, and it considers the entire distribution, not specific parts. It takes into account the fact that you don't need a risk factor model like for volatility. It does only consider losses as risk, not gains. It acknowledges the effect of diversification, and contrary to, for example, market cap weighted indexes, it can pick up significant positions in smaller up and coming assets. So as such, iVaR is at the heart of our product called Portfolio Optimizer. So besides this novel concept of risk, our Portfolio Optimizer offers a general tool that is built to customize portfolios at scale. So how do we do that with our tools? So typically an optimization starts with a selection of supported instruments. This can range from ETFs, over stocks, mutual funds, and of course, digital assets. In fact, we can support any instrument, any asset class for which there is sufficient time series data. Next one defines the objective of the optimization problem. Do you want to maximize risk, maximize return, minimize risk, or do you have any other preference? Other preferences and limits from different kinds of types can be set via exposure constraints, and practical limitations of the portfolio construction like minimum maximum size, minimum maximum trade size can easily be set via our technical constraints. Last but not least, we of course have iVaR for novel measure of risk, but we do support also the traditional risk measures like volatility, like conditional value at risk. So if you want to stick to your preferred measure of risk, that is out of the box supported as well. But as explained before, we would especially recommend iVaR for digital assets. And all of those configuration options, together with our scalable cloud-based infrastructure, assure that we can really create truly high personalized portfolios at scale. And now how this portfolio construction methodology, given this novel concept of risk, can be used in crypto will again be presented by Mathieu.
Thank you, Martin. So if you are going to be investing in crypto, you need to understand how you go about it. And now you know what risk measures you might use for optimizing portfolio and why iVaR is interesting. But let us review the other options and the current landscape of crypto offering. So if I omit anything that has a traditional finance wrapper around it, it can broadly be divided in the following 4 categories. So trading, indexing, baskets, and hedge funds. We're omitting the traditional finance side of the equation because those products only really make sense for institutions that can't hold crypto directly, because digital assets are a bearer asset and they can often be had in tiny fractions, and there are often no fixed fees for trading on crypto exchanges. So it's much less relevant to put it into a fund than it is for stocks and bonds. And it's much easier for each customer to own a complete portfolio outright. So trading, indexing with themes, and hedge funds are kind of the landscape. Hedge funds, they're not accessible to most people. And there are many, and they don't all have a directional strategy, so we won't cover those. But they do exist, and it's estimated that there are around 1,500 in the world. One solution which has been popular in the past is for people to just go and actively trade. Admittedly, that's more of a value extraction than allocation strategy, but it is considered by a lot of actors. So let's take a second to dwell on it. Because self-execution trading platforms are really aplenty in crypto, and trading is where crypto has its roots. Trading is mostly done thanks to technical analysis or mimetics or narratives, market sentiments, and understanding flows, but there are not a lot of fundamental approaches because there are no good valuation frameworks yet for digital assets. But as the industry matures and an increasing number of people start considering the asset class, we think that it's worthwhile to reconsider the approach. And this is where we can draw on the lessons learned from investors over the past 100 years and from behavioral finance more recently. First, by drawing parallels to traditional finance, most people in traditional finance don't trade. They entrust the asset selection and weighting to third parties. So banks, ETFs, wealth managers, pension funds are all there to take the burden off of the shoulders of people who aren't interested in taking a fundamental approach to understanding equities or watching the debt market or understanding the macro environment, running complicated mathematical models for portfolio constructions, and sending the orders to trading venues to rebalance their portfolio. Also, behavioral finance tells us that trading is actually not very good for your portfolio. So 70 to 97% of traders lose money, according to research. It's mostly due to erratic behavior, and that kind of erratic behavior even sees investors tend to underperform investments. And behavioral finance teaches us that then the best course of action is usually just to make a plan to achieve and get a goal and then stick to it. Because even a relatively bad strategy that is well adhered to has a better chance of yielding good results than an excellent strategy that is haphazardly executed. And the conclusion is that when contemplating digital asset, much as when contemplating investing anywhere, really the best way of going about it is not with emotions and seeking a thrill, but with a systematic approach to draw up a long-term strategy and put it on autopilot so that your brains can't play trick on you, or doesn't play trick with the investors. And then the indexing and thematic indexing would have some merit then. And what's also interesting to note is that investors do want advice. So that form of delegation of power or discretionary mandate is probably going to be the preferred mode of allocation to crypto for the vast majority of people. On the left, you can see, in fact, EY even found that already today, investors with significant exposure to innovative asset classes exhibit above average appetite for more advice from their wealth management provider. And in the end, that's really good both for the investor and the institution offering access, since it has a broader appeal. The assets are a lot stickier, revenues are easier to predict, and a higher differentiation commands a premium. So are indexing and baskets the solution to offering an easy systematic approach? Well, our argument is that while in spirit maybe, for digital asset, it definitely is not. We see problems both at the level of deciding what assets to consider and also when looking at what weights to give them. So when looking at the crypto market, it's important to understand what one is looking to get exposed to. The number of listed assets grows really quickly, but they might not all be things you would like to hold for the long term. So as of late May this year, CoinMarketCap had 25,000 assets. Earlier in the year, it was 22,000 assets. In 2022, 16,000. 2019 was about 2,000. And then 2018 was about 1,000. So it's definitely growing fast. And the problems are the following. In the choosing asset part, market capitalization is not fully diluted market capitalization. So you kind of have to choose one or the other to see who's bigger, because between assets that haven't been released to treasury, assets that are locked up to pay the venture capitalist, and the programmatic emission, what is currently circulating can be quite different from what will be circulating. Also, not everything in crypto is in fact crypto. If you check out CoinMarketCap, you will see that some of the largest assets are stable coins, and then there are asset-backed tokens, and those are probably not what most investors are looking for when they seek to get exposure to the potential success of crypto networks. Also, it's hard to know what the next narrative will be. VCs don't know, Ethereum researchers don't know, even Vitalik Buterin admitted to not anticipating the NFT craze. So defining a large universe based on quantitative criteria offers a better chance at holding winners than even educated guess. Also, there's no guarantee of liquidity. So considering purely that market capitalization of a given asset will give you zero guarantee that you will be able to sell it should you need to. Also, it's not all investment grade. In the top 20, you have meme coins or tokens with very low circulation, low activity forks, even some legally encumbered tokens that can keep a relatively high market cap despite the investment rationale being relatively weak. And then if you're going to do baskets, well, you have to recognize that they're always late. While it might feel convenient to buy a metaverse or a DeFi or a layer 2 basket, the there is an inherent problem with buying baskets in an emerging industry, is that you can't build the basket before the narrative has coalesced. But by the time the narrative has coalesced, you're probably at the peak of inflated expectation, which we mentioned earlier. And so most of the upside is behind you. And then when it comes to choosing the weights, the crypto market is very top heavy. To make matters worse, the assets at the top are extremely correlated. So if you go by market cap, you're very likely to hold at least 70% of Bitcoin and Ethereum. And then quantitatively, those two are pretty much the same asset. Also, black swans require fairly quick reaction. So investing in crypto is more akin to venture investing. And when things blow up, they blow up fast. You might remember Terra Luna last year, which wiped out 50 billion from the crypto market cap in about a week. And if you're rebalancing your index quarterly, you're probably taking a 20% loss right there. Also, it pays to be early, and the top is really never early. And by market cap, you can't really be early. If you look at the aptly named Bitcoin dominance chart, you will quickly see how much Solana, Sol, the 10th largest asset, you're likely to own with a market cap weighted approach. It will be around 1% and probably a little below that even. So if we back up a little, so far we've covered why you might want to consider crypto, the history of risk measures, and why we believe that iVaR is well suited for crypto portfolios. That indexing is an allocation strategy has some fundamental problems when dealing with crypto, and then that both the asset selection and at the weighting, which should both be considered differently. And then we've also said that it's possible to backtest strategies using iVaR. So what we can do now is rebuild on all of that and demonstrate what we mean. So first, we'll take a good rules-based universe. We'll apply iVaR to it and benchmark it to some other solutions. And we will even show you what it might have looked like if you had added a little crypto with iVaR portfolio as a satellite to a traditional portfolio. So for the universe, what we do is that we take the top 200 from CoinMarketCap point in time listings, and we exclude the stable coins, we exclude the meme coins, we exclude the privacy coins because regulatorily it's complicated. We exclude the wrap tokens because those are synthetic assets. It's not really any point. We take the assets that trade on Binance because you have to trade somewhere, and Binance kind of has the largest selection today. And we filter for relative market cap and relative volume. So market cap does play a role in the selection, but so do volume because we want to make sure we can sell them. And we take those not as absolute number, but as numbers that are relative to the overall crypto market cap and volume. And then if we do that from 2018 to 2023, it shows that we basically have 180 assets that are being considered over the period. And if we look at what's actually investable at the start of each years, we see that in January 2018, we had about 37 investable assets. And then in 2019, we had 49, and then back down to 34 the year after, and then 56, and then 92 in 2022. And now we're back down to 86. And so with that point in time universe, we can go back to 2018 and use the InvestSuite Portfolio Optimizer to run weekly optimizations, which will run on Wednesday with maximum 30% per instrument allowed in the portfolio, and the objective to minimize iVaR. And as we'll show you in a bit, the universe might even be further tweaked in any ways you want. And we'll show you the example of Awesome Finance, which ran the portfolio from 2019 to 2022. And now I would let Martin show you the results of using the InvestSuite Portfolio Optimizer to run the backtests.
Thank you, Mathieu. Let me once more share my screen. So indeed, we run this backtest, and as said out of the previous slide, the goal in the backtest was to minimize iVaR, so to minimize the number and the size of the drawdowns in your portfolio, and to target a fast time to recovery from those losses. So this aims actually for a smooth ride in your base currency, which is the euro in our case. It is important to note, though, that it is restricted, or portfolio construction methodology was restricted to be 100% invested all the time. So hence, if there is a general drawdown in the full market, this cannot be avoided because we need to be invested in this test. And in this graph, we show the results of our backtest next to a market cap weighted and an equally weighted version of the top 10 point-in-time instruments. Those were also rebalanced on a weekly basis, just like the actual backtest. The graph illustrates that wisely allocating weights to your instruments can really reduce your risks and allows you to diversify your portfolio with instruments before they are hyped, especially if you know that since start of this backtest, Bitcoin is responsible for at least 60% of the market cap, so 60% of the blue line, and the weights in our portfolio are kept to 30%, then this result really stands out according to us. The top 10 equally weighted benchmark quickly drops to 0 here and really never recovers from that, since it has to hold a lot of altcoins, and altcoins massively dropped in 2018. Also, again, indicating that choosing your weights wisely is of paramount importance in this digital asset space. Now, on the current slide, we have exactly the same results, but then rebased on the 1st of January 2019, so we can compare again a bit better with the top 10 equally weighted portfolio. Now we see similar results. We still see that our iVaR methodology stands out. And in the end of 2023, one might note maybe a better performance for the market cap weighted benchmark versus both iVaR and equally weighted benchmark. But this can be once more explained by the fact that there was a shift in market cap from alternative coins to Bitcoin and Ethereum, and together those last two, so Bitcoin and Ethereum, now have more than 75% of the market capitalization. So both the top 10 equally weighted and iVaR portfolio cannot match this portfolio because they're just not allowed to hold that many, such a big weight to Bitcoin and Ethereum. Now, earlier in the presentation, we touched upon the novelty of our measure of risk and why it is such a good measure of risk to incorporate in your portfolio construction of cryptos, especially versus traditional risk. As said earlier, back then, our portfolio optimizer is a general portfolio construction framework, and it can serve also traditional measures of risk. So in this backtest, we did that, and we show the performance of different risk strategies since 2019. So exactly the same backtest, where risk is minimized on a weekly basis with different measures of risk. It can readily be seen why we would not recommend using traditional risk measures to construct portfolios of digital assets. So let's zoom, for example, in on two different subperiods where we can illustrate the theoretical aspects that we explained before. For example, during the first half of 2021, there was a huge rally in the crypto markets, and instruments with a larger volatility were left out in the volatility backtest, despite some of them were even not showing any downside risk. So purely the fact that they went up steeply caused a large volatility, but there was no downside risk visible in the time series, but still they were excluded by the volatility backtest. Next, second period, during the mid of 2021, you see that both the iVaR portfolio and the conditional value at risk portfolio, they dropped around the same order of magnitude. Afterwards, after the drop, however, with CVAR, with conditional value at risk, there is no incentive anymore to pick up instruments that exhibit a strong recovery profile. So they have both the same drop, but then afterwards, there's no incentive anymore for CVAR to switch to other instruments that have a better recovery picture. So that's what we see here. And backtests, yeah, they're always nice, but yeah, can this be applied in practice? Does this work in practice? Well, the answer is yes. As already indicated, since the fall of 2019, our portfolio optimizer has been used by Awesome Finance to serve their crypto autopilot. So a screenshot of this can be seen on the left, how this app worked. And their setup was really very similar with the one shown in the backtest. Only they added an extra human filter on the universe based on their personal expertise and beliefs. And next to that, the algorithm had the possibility, but not the obligation, to rebalance on a daily basis. Again, if you look at the time series, similar results, similar effects can be seen as in the previous backtest. And this client, they use our portfolio optimizer, our product via our scalable API. So let's maybe quickly demonstrate how that would work in practice. So as explained in the theoretical part, typically we start with a certain portfolio. Then you select the instruments that you consider to be in your portfolio. So now we took the last possible universe that we took in our backtest. Next, if you know which instruments you consider, you can define the objectives. I want to minimize risk, iVaR in this case. You can set some constraints. So here we set no cash, meaning that you need to be fully invested all the time. We set some maximum weight, so an upper bound of 30% per instrument. And for this little test, we also say, okay, we want at least 1% per instrument because you don't want to end up with any tiny instruments in your portfolio. Then you can send that optimization request. We will handle it and we will return your location where the optimization result will be stored. So you get results, you get the link, you get to the location where we will store the result, and there you can just fetch the result. And then you will see some information about the current solution. So we started with cash. You can go to the optimal solution. So in this case, it's displayed in percentage, but can also be in units or amounts. You see which instruments would be now optimal in your portfolio. You see some extra information. And last but not least, we give you some information on the portfolio update, which we recommend to update that portfolio. If so, why would we do it? In this case, because there was too much cash in the portfolio. And what are the orders that correspond to this? Here as well can be done in units, amount, or percentages based on the preferences of you. And then last but not least, we want to illustrate what our solution can offer to most individual investors, because most of them, they will not be willing to invest all of their money into digital assets, and they might look for a hybrid solution. They might want to consider it as an alternative asset class to diversify their portfolio. In this graph in blue, you see a 60-40 equity benchmark portfolio that is also rebalanced on a weekly basis. And next to this, we put this exact portfolio in the core, so 95% core benchmark. And then we added a satellite of 5% crypto. And it's important to note that such a core satellite approach is out of the box available via our portfolio optimizer. So you can really adopt such a core satellite approach with our tool, and then you can run it like this. And then it can be seen that given only 5% satellite, the downside risk in your portfolio is only slightly higher, but there has been a significant upside potential introduced by adding that preference, adding that small tilt in your portfolio. So also indicating that you can use our tool to extend your current portfolio management with a small digital assets part. And that concludes my part on the presentation. So back over to you, Joyce.
Thank you very much, Martin, and also the big thanks to Matthew. So maybe a brief couple points to summarize. So the crypto network is obviously still continuously growing. Regulations are formalizing and the technology is improving. And you mentioned that crypto assets have quite a different structure than traditional assets. So indexing and baskets are suboptimal, as both the asset strategy and weighting should be treated differently. And others can then use InvestSuite's iVaR through portfolio optimizers so that we can meet the unique structure of these crypto assets along with other assets. And portfolio optimizer, by using optimizer, one can actually completely customize a variety of specific constraints and chosen objectives and instruments to build personalized crypto and traditional portfolios for your end clients. And since we've also seen over the years the success in the back tests, as you've shown, we've also seen the live performance of these crypto portfolios versus both market indices and portfolios using other risk measures. And lastly, and interestingly enough, we saw how an allocation might perform and add value in combination with a traditional diversified portfolio. So maybe in the last 5 minutes or so, I'll take and review some questions from the audience here. Some logistics questions for me. So we will be sending the recording via email to all the attendees here. So we've got your contact information and no worries there. I think here there is also a question about a further demo of the solution, that's perfectly great. As you can see, my contact information is on this screen here, as well as Martin and Matthew. So feel free to contact any of us and we can schedule that along. Or please feel free to respond to the follow-up email that we will be sending. As well, we have another question about iVaR. Because it focuses on risk, how about returns? Do you give up anything by minimizing risk? Maybe Martin?
In the backtest, we currently only minimized for risk because expected returns is something, let's say, that can be done less in a quantitative way. We can easily incorporate expected returns. So if someone has views on the market, they can be incorporated, and then we do real risk return optimization. But since we are a software provider and we don't have any explicit views on the market, we stick for the time being to minimizing the risk in your portfolio, which according to us also perfectly makes sense for digital assets. But as said, if there are any views on the market, they can easily be incorporated via our portfolio optimizer.
Okay. Perfect. Does the portfolio optimizer or this iVaR algorithm, have you used AI or machine learning in this?
Sorry, yeah, a very valid question. This all depends actually on what is considered AI machine learning. So yes, the portfolio optimizer does include the incorporation of past time series, and it learns from that. But we are not using any, let's say, we are not using any neural networks or stuff like that. So that's what we are not using, but we are indeed learning from the time series. And also we have a PhD candidate in our team who is actually doing research on using this time series to make in an AI machine learning way to make better predictions of what the drawdowns, what the iVaR could be in the future.
Maybe as a follow-up to that one, and quite relevant actually, because specifically crypto markets are still young, having only been around for a little while, do they provide sufficient data for your algorithms and your models?
Yeah, very valid question again. So typically with our algorithm, we require 3 years of historical time series data. But as we all know, the challenges in crypto, indeed, let's say we made sure that our crypto algorithm is able to work with only around 7-8 months of history. Of course, we do need some history to know how they behave. It can also be backfilled automatically if that's preferred, but typically we would require for crypto instruments around 7 to 8 months of history before they can automatically be included in our algorithm.
Perfect. Thank you so much, Martin. I think that's it today. If there's any other Q&A, please feel free to send it our way. So thank you so much, everyone, for your attendance. We will be sending up the follow-up material, again, as I mentioned, with slides and recording of today's webinar to you over the coming days. Please feel free to reach out to any of us via LinkedIn or email if you have any questions. And as well, please follow InvestSuite on LinkedIn or socials for our upcoming webinars and events and any updates. Thank you very much.